Good morning, everybody, and welcome to the Q1 2022 Market Insights. My name is Lawrence Lennon, and I'm the Managing Director of CBRE Cambodia. Today, I am joined by my colleagues, Kinkesa Kim, who heads up our research and consulting team, and Dalit Shin, who heads up our valuation department. Welcome, everyone, and thank you so much for joining us, and thank you very much for the team putting this together. They put a great deal of work into it. So thank you to everybody who participated. Please feel free to send in any Q&A you may have. There's a function at the bottom of the screen, and we will have a session at the end to answer any questions that you may have. So please feel free to ask anything. We will do our best to support you. In terms of the session today, we will kick off with an overview of the macro context, to begin with, presented by myself. This will be followed by an introduction to the commercial market. So Dalit Chin will give you an overview of the office and retail segment. This will be followed by Kinkesa Kim, providing an oversight of the condominium and landed property market in Q1 2022. This will be concluded by a Q&A session, as I just mentioned, so please feel free to send in any questions you may have. You can ask anything you like, we will do our best to support you. So without further ado, we will kick things off. So as I'm sure you all know, in terms of, sorry, we're having a bit of a moment with the clicker. Perfect. Thank you very much. So in terms of the key indicators, we've got a bit of a mixed bag, as I'm sure you can see, but interestingly enough, I would say that that's not necessarily the worst situation to be in, considering over the past few quarters, we only really had downward moving trends other than COVID cases. And as everyone knows in the country at present, COVID seems to be in a comfortable position. Having said that, office, condo sale prices and prime condo rents are on the downward trend. Having said that, though, prime office and retail occupancy has stabilized. And in addition to this, prime retail for the first time in the past 12 months to 24 months has actually moved upward. And this is without doubt a reflection of the success of Cambodia's vaccine drive. So landlords are starting to feel a little bit more confident as people are slowly moving back to the malls. Actually, I shouldn't even say slowly moving back to the malls. I should say rapidly moving back to the malls. So as you will see, as we go into the Google Mobility Tracker soon, things are really kicking off. So it's quite exciting for the market. In terms of approved investment into construction, as you can see from this graph, things are certainly taking a downward trend, which is to be expected with all things considered, not only in terms of the domestic market, but also the regional market. As many will know, a great deal of investment comes from the Chinese market, and without a doubt, that has been slowing down, and the amount of confidence we're seeing from Chinese potential developers in the market has slowed. And this is a reflection of what's going on in China itself, without a doubt. In terms of the key headlines, Q1 2022, without doubt, has been a period of firsts and a period of foundation building for Cambodia. There are a lot of positives, we would say. Cambodia witnessed the first public listing of a real estate company. It witnessed the entry or the first opening of a really large scale retailer, H&M. We witnessed the opening of Aeon's logistics hub down in Sihanoukville, and without a doubt, very impressively, Cambodia being one of the first, if not the first country in Southeast Asia to truly open its borders. And you know, anecdotally speaking, if you're talking with any hospitality GM, they are certainly happy. Things are going in the right direction. I've heard more than one GM tell me that they had 100% occupancy, which is you know, a brilliant result and a reflection of how well COVID has been handled domestically. But importantly, this doesn't only feed into hospitality, it feeds into the office market. People are back in the office. It feeds into retail, as mentioned. As you'll see in a second with the Google Mobility Tracker, people are back shopping, which is really positive to see. In terms of other headlines, without doubt, Cambodia entering RCEP or RCEP is a huge milestone as well. This is the largest free trade agreement globally, and it is going to be feeding into the future of trading, manufacturing, and even the logistics sector here in Cambodia. As mentioned, in terms of COVID and our recovery from the pandemic, you can see for the first time in Q1 and even Q4 to some extent that things are without doubt going in the right direction. Interestingly enough, if you notice workplaces, as soon as the travel restrictions had been lifted, there's been a big jump in workplace activity. And this is likely a reflection of overall confidence of people in the market, and people are back in the office. There have even been some rumors in the news recently of removing the mask mandate in certain areas in the country, which again just is a reflection of this confidence that we're back in action. So again, just great to see. Again, if you're looking at retail, recreation, if you're looking at residential, everything is going in the right direction. And that in and of itself just shows that Cambodia has laid the foundation for the next chapter in its growth story. So we are very happy to see where things are going. We're cautious. I must add that we're cautiously optimistic, but fundamentally it's good to see. When the team showed me the table on the right-hand side of this slide, I was a little bit concerned to see Cambodia ranked 102nd. But then I took a closer look, and I was, of course, very pleased to see this is just, again, a reflection of where things stand domestically. We have only around 38 cases over the last 7 days on average. Regionally speaking, once again, a real outlier. If you're looking at Thailand, if you're looking at Vietnam, if you're looking at Singapore, the case numbers are significantly higher. So again, step in the right direction. As alluded to earlier, the quarter has been used, or not even the quarter, the past 12 months or 24 months have been used wisely. Things have focused on how can we improve our infrastructure, and that is going to tie into the improvement of the hospitality market. So Siem Reap's road infrastructure development, which I'm sure many online today have witnessed, this is going to make Siem Reap a much more attractive destination, not only to visit on a short-term basis, but even to live there. We foresee that this could allow Siem Reap to become more attractive to the digital nomad type of traveler, or even helping to make Siem Reap turn into more of a multi-visit destination rather than a single visit destination. Other areas that we're seeing in terms of infrastructure, Siem Reap's International Airport is progressing. The airport down to the south in Tak Mau, the new international airport, is again going in the right direction. Kampot International Tourism Point is almost complete. We had our team down there earlier on this week, and this is actually some drone footage of the progress. There's so much going on in terms of infrastructure development that we couldn't necessarily even include everything here on this slide. The Phnom Penh Sihanoukville Expressway is scheduled to open in Q3 this year, which will again help not only tourism, but also trade facilitation. It will speed up travel and help improve getting goods to end markets. I was in Bavet at the weekend, and I actually saw the road expansion ongoing. The study was only done in Q1, and to see the government launching this work into action, it's positive. It's great to see. So that will certainly feed into allowing faster, more effective trade facilitation between Cambodia and Vietnam. I haven't even mentioned the new Sihanoukville master plan, which is ongoing. Again, it will certainly help to reposition the south or the coast of Cambodia. So a lot of really interesting and foundational developments taking place in Cambodia's infrastructure space. Without further ado, I will pass over to Dalit Chin to provide an overview of Cambodia's commercial space. Thank you very much.
Thank you, Lawrence. And hello, everyone. Let's now take a look at the office market for Q1 2022. So this last quarter, we welcomed 3 new completions of office buildings. One of them is SP Building. It's a centrally owned Grade C office in the Tu Quoc district. 2 other buildings are Grade B offices. One is the strata title office at the renowned The Peak near Diamond Island. Another one is called the Business Development Center in Chua Chung Ba district. It's a centrally owned building. It's a headquarter of the Business Development Center, which is a part of the Ministry of Economy and Finance. And this is a rising trend that we've been seeing, that banks or large corporations, government institutions are building or acquiring their own headquarters and then leasing out some extra space for external tenants for more incomes. In terms of launches, this past quarter, we saw no new launches, which is actually a healthy sign. And we'll see why. We'll see why when we look at the occupancy and supply of office market offices in this slide. So throughout this year 2022, we're expecting to see about 100,000 more 100,000 square meters more of net leasable areas being completed into the office market. And in this first quarter, we saw about 30,000 square meters of those being completed with the 3 buildings we just saw earlier. This is a lot of supply, which push the occupancy rate down by about 1.2% Q-on-Q compared to the last quarter of 2021. And the occupancy rate for centrally owned offices on average is now at around 67%. Although it is another drop from the last quarter. If you look at the slide, we look at the graph from 2019, the occupancy rate actually had been dropping at a steeper speed, and this is mainly due to the large amount of new stock being complete in 2020 and 2021, and because the amount of supply starts to moderate a little bit this year, we also see that the occupancy rate also starts to stabilize a bit. If we look at the rent, we see a similar trend here. Overall rental rates for all subsectors across the office sector is generally stabilizing. Grade B, Grade A and Grade B offices in the central locations, the rent stayed the same as the fourth quarter of 2021. Grade C, on the other hand, are actually increasing their quoting rent by about 1.6 to 1.9%. And if we look at the Google Mobility Tracker for office, for workplaces in Cambodia, we're actually seeing that more people are going to work right now than during the pre-COVID period. We're actually seeing an uptick over the baseline starting from earlier this year, around February and March. So with these statistics, we ask ourselves, will we see a turning point for office market this year? Will rental rates and occupancy rates start to be positive again? But although there are some positive indicators in 2022 compared to 2020 and 2021 for office market, we still need to remember that there are almost 100,000 square meters more of office space to be complete this year, and which will push the whole occupancy, the whole office supply to in the whole market to almost 1 million square meter in that leasable area. So all of this will take a while to be absorbed by new tenants, by expansions of companies. So it will take longer than just this year to see a positive increase in terms of rent and occupancy rate. So the key trends that we're seeing this quarter for office market, again, rents are settling, the same with occupancy rate, and leveraging on this situation where rents are getting competitive, are much more competitive than last year. Occupants or tenants are actually changing their leasing strategies and taking up more spaces than before. We see our average deal size increasing from around 250 square meters to almost 300 square meters per deal. So this is a positive sign. Also, tenants are still continue to prefer better quality spaces and better location, because there are more of those buildings now offering very competitive rates. The new buildings are better, and we see tenants moving on from older grade C offices to newer and slightly better grade C offices, or upgrading to grade B entirely. Now let's move on to another commercial sector, retail. For retail, in the first quarter of this year, we saw 4 completions and 3 new launches. Most of those are community malls. So some of them are Chipmong Sansok Mall. It's a new community mall in Sansok district. Prince Times Square, another community mall along Miradom Boulevard, and 60th Avenue just launched along Honsan Boulevard. Let's take a look at the occupancy rate and number of supply in detail. So throughout the whole year, we're expecting 200,000 square meters of net leasable spaces for retail. So similar story as offices. This 200,000 square meters of office space will increase the entire retail supply to by around 50%. And as of the first quarter, about 13% of what we're expecting to see complete this year has been completed, and almost all of those are community mall. So we're seeing community malls are still continuing to be the trend. It's very preferred by developers and consumers alike. With all of this supply, the occupancy rate of retail projects decreased slightly further by around 1.5% to right now the average is at 66.6% as of Q1 2022. If we are looking at how busy those malls are, it's actually a lot busier. And if we look at the graph on the lower half of the slide, Global Mobility Tracker, more people are going to the malls starting this year, earlier this year, which is a very positive sign. All of these support the rent the rental rate to not go down too significantly. Actually, Prime Shopping Mall, the rent stayed the same, the quoting rent stayed the same as the fourth quarter of last year. And Prime Retail Podiums actually increasing their quoting rent by around 5.6%. This is mainly due to the new launches of two high-end Prime Retail Podiums in the central business districts, which pushed the average by about 5.6%. Community Mall, as a reflection of the increasing supply of community malls, the rent is decreasing a little bit by 1.6%. The only one that is going down a bit significantly is Prime High Street, dropped by 6.8% compared to the last quarter, and this is this shows how retailers are moving to a more established retail projects. And with all of those new malls comes new entrants of brands and new expansions. And it's a very exciting quarter for retail market because this quarter we saw 44 new brands and zero brand exits. If you look at the graph on the first left-hand side, it's a big jump from the last 2 years. 44 new brands is a similar level to 2018, 2019, and 6 of these new brands are large international brands. And I would say for the very first time in many years, these new international brands are not just F&B brands, not just bubble tea brands, but they are fashion brands and like H&M, OVS, and Aeon Phnom Penh, and Wilson Art furniture brand at the Design Village. Other of new brand entries are local brands, and most of them are going into the community malls. Some of them are brought in by the developers themselves in order to help fill up the space. On top of these new entries, we also saw 49 brand expansions and just 1 brand closure. So these are positive signs that we're seeing in the retail market. Some key trends are new brands, both international and local brands. Community malls continue to dominate the market. We see those popping up throughout the whole city, not just in central locations, but also in outside districts where there are new residential clusters. Some of them are actually built inside a large landed property projects like Chipmong to support the needs of the residences there, and also to catch the footfall within the smaller catchment areas around those projects. And definitely footfall improved. We just saw in the GoGo mobility tracker earlier, but we also see it evidently outside that the roads are busier. There are now traffic jams around the shopping malls. There are queues outside of new stores opening. All of these are supported by the effective vaccination rollout and boosters, and they give confidence to shoppers to start shopping in the malls again. And the increase in tourism and opening of the country in the last few months of 2021 definitely helped with improving these footfalls, improving the retail malls to get them back to life. So these are all for the commercial sector. I'll now hand over to Kesa, who will cover the residential sectors.
Thank you, Daluj. Thank you, Daluj. So before moving on into the residential real estate aspects, I just want to remind our attendants attendees that we are also welcoming a lot of questions, and we'll have a Q&A session at the end. So if you have any questions, please feel free to pop it into the Q&A tab. We have seen a few questions coming in already, and we expect to see more. Thank you. So without any further delay, I would like to jumpstart the discussions on the residential real estate aspects. Let's begin with having a look at condominium market. So in the condominium market in the first quarter of 2022, we also see 3 new completions, namely Picasso City Garden, the Peninsula Private Residence, and M Residence. All of these 3 projects are positioned in the high-end and mid-range segment, and are all located in Bang Keng Kong district and Choi Chong Wa district. Similar to the office market that we saw earlier, no new launches happen in this segment, which is not necessarily a bad news for similar reason that we saw in office market as well. So looking into further detail why we think no new launches is a good news, is that if you look at the expected supply coming into 2022 and 2023, you can see there's a big jump from 2021. I shall highlight as well that some of this expected completion in 2022 were actually the delayed stock, which was expected back in 2021, and now are moving their timeline into 2022. The jump, to put things into context, we are expecting up to 13,000 units to be completed in 2022. This is approximately 40%, nearly 40% growth year on year from the last year. And up to the first 3 months of this year, we only saw about 5%, which is equivalent to around 700 units being completed in the first quarter. The continue ongoing delays in the construction of condominium projects is now starting to pose concerns, and we'll start to see that some of these will probably hang around for around 1 or 2 years further into the down the line. And there's also some aspects of the concern that will impact on the price, which we'll discuss further in the next slide. So price-wise, we continue to see high-ends continue the downward trends in terms of both sale prices and rental rates. So if you compare both graphs that we are presenting in this slide, the left-hand side shows that sale prices of high-end condominium contracted by 4.1%, while their rental rate contracted by also around 4%. Meanwhile, the segments such as mid-range and affordable starting to stabilize. So whereas as we can see, the sale prices dropped by only 0.3% in mid-range segment, and rental rate of mid-range segment grows by 1.1%. On the other hand, affordable start to see a slightly better increase, which is a 1.6% in the sale prices and 1.4% in the rental rates. Reason for both rental rates and high-end, sale prices increase in mid-range and affordable segment. We start to observe that a lot of local buyer right now start to seriously consider or actually made decisions of purchase of condominiums, which is previously dominant by the international buyers, and right now its price coming down quite significantly compared to 2020 and 2021. A lot of local buyers now start to grab this opportunity into diversifying their investment. For the rental aspects, we're also starting to see the expatriate community return either in terms of labor force or as a tourist. This is also we think the motivation behind the slight increase in rental price, or we can say a slight recover in some aspects. Other trends that we see in condominium markets happening is buyers are looking for better values of their investment. By values, we mean both grades or quality of the products and the sizes of the condominium units. As right now, the buyers are taking over. The market is potentially be the buyer's market right now. This is what we can see how buyers are now more selective of their making of the investment. Second trends that we saw happening in the market also with buyers trying to more preferred in terms of move-in ready units. This is, we ask ourselves whether this is just an instant gratifications or just simply risk mitigation among buyers. We feel like there could be a bit of both. If you look at the ongoing construction delays that happened in the past years, buyers start really having concerns and a bit of lack of confidence in terms of the projects that are under construction. This is why those completed buildings appear to be more attractive for many buyers. This is why we see more activity happening in the secondary market or resales of units. No new launches continue to be the trends in 2022. We might expect very few launches, if not zero new launches, happening in the next 3 quarters. This is not necessarily a bad sign, which we think is actually quite healthy for the market with a lot of supply hanging around right now. So hopefully this will give the sector some space, some breathing space to absorb the existing units. Moving on to another aspects of residential real estate, we will have a look at landed property, which is reported in a 6-month period as opposed to quarterly periods as in the previous sectors. So as always, regardless of what happened in other markets, landed property always has so many launches, and we never ever been able to fit all the launches in one slide. So we try our best to pick some of the interesting projects to present here. So in this slide, we presented 4 projects as selected from 13 up to 39 new launches over the past 6 months. Namely, there are Angkor Palace, Borei Angkor Palace, which is located in Dong Khao district on San Boulevard. We saw a new launch of Prince One Tropica, which is the first landed property of Prince Real Estate Group. ELT, the Courtyard 60M, which is also the first project of ELT Group, who is a educational provider. And Bosba Absomera, which is also developer from a different trading sector. So we're starting to see that new developer entering into landed property market began to take better shape right now, as I may project here. Nearly 40% of the new launches among the 39 new launches that we saw in the past 6 months are developed by first-time developer who are either existing real estate developers who was active in different segments, for example, high-rise, condominium, or office, now enter to landed property, or completely new real estate developer who were actually quite successful in other trading sector, for example, the ELT, who is the school operator, as we saw in the previous slide, as well as many others. However, we observe that the new projects that are introduced from new developer tend to be in moderate size. This can be understood to be the pilot or first learning point for this new developer, and carry on into the next project. They will carry any lesson learned that they had in the first project. In terms of the total number of supplies in landed property market, we presented here on the right-hand side the historical trend. In 2022, we are expecting accumulated completed supply of landed property up to 310 projects, growing from around 285 projects in the previous year, and further grow to nearly 400 units in 2023. This is again quite a rapid growth in terms of completions that we are expecting. However, we may expect some construction delays as recent news seeing more obstacles and price increase in the logistic aspects. So some potential delay could be expected, although probably not as severe or concerning as the high-rise condominium. In the discussion over the price trends of landed property, we are presenting two graphs here. First, represent the price range of each unit types, and the second graph represent the historical changes 6 month by 6 month in terms of average prices. If we look at the first, let's look at the historical changes. We see that most of the unit price are stabilized as the competition rise. However, there's a notable growth in shop house prices, average prices of up to 4%. On the price range side, we also see that the price gap between the starting price of a shop house all the way up to the maximum also have a wider gap if compared to other unit types. Reason could be the offering of shop houses are quite popular among a developer. So we can see that developer across all the board, ranging from affordable to mid-range to high-end, all are offering a different type of shop houses, whether at an affordable price, mid-range price, or even higher price. We think that this trend will continue at least for the rest of the year, and we'll probably see more competitiveness in terms of price competitions among especially the new developers that enter into the market. Other trends that we saw in landed property market is the in effort to differentiate themselves, developers are now offering more facility. And for example, the offering of retail space, as we can see in some of the Chipmong projects, offering of schools right inside the projects, or even healthcare facility to support the livelihood of the resident inside the landed property projects. Additionally, we also saw that developer, especially the new developer, getting more creative and introducing more innovation into the landed property aspects. We start to see new formats, which is differentiate from the older standard unit formats that we saw existing in the market. We think that this is actually a healthy competition among the local buyers, local developer, which will eventually beneficial for the buyers who now have more choices and expecting a better value for money of their investment. Last trend that we also seeing is the rules and regulation changes, or in other words, we can say enforcement. As recently we see the Ministry of Economy and Finance and Ministry of Land Management issue more broadcast warning for developers who are developing or marketing the landed property project without a proper license and permits, are now probably facing further consequence. So I think for this reason, we probably expect to see some slowdowns in the new launches as the law and regulation are now becoming more enforced. So that is all of our presentations. Thank you very much for your attentions. We now will start accepting again the questions from the audience, but before going to answering those questions, we would like to know from your side in terms of what you think of the recent quarter, as well as what happening in the next 2-3 quarters down the line. So I just launched a poll right now. You should be able to see on your screen. So please join us and let us know what you think. First question that we ask is, have you seen any improvement or deterioration in the business environment in the first quarter of 2022? Answers are ranging between the degree of improvement or deterioration according to our audience perspective, or either no changes. So we start to see some response, thank you, coming in right now. It seems that a majority, probably some of our audience right now, seeing slight improvement, which is very pleasant to hear. I'll move on to the second questions as the response is starting to coming in. Aside from COVID-19, what do you think posed the greatest threat to our real estate market in 2022? We start to see more response coming in between Chinese economic slowdown and the oversupply issue. Okay. For the last questions that we asked, what assets are you investing in 2022? We start to see some responses as well. Currently, land is standing up on the list, and some audience say that I'm going to sit on my money. We start to see some responses coming into industrial and landed property as well. So it's quite diversified in the responses that we accept. So thank you. We'll leave the poll open. We're still accepting responses, but right now I'll hand over to Lawrence to start screening through some of our questions that we received. Thank you.
Thank you very much, Kessa and Dalich, for those insights. Really interesting to see where the market is going. We will kick off with the Q&A session now, and I'm slowly going through the list, and I will ask Dalich the first question, and Kessa and myself may jump in to add in a few additional insights. So I think the first one will focus on the office market. So Dalich, where do you see the office market heading over the next 6 to 12 months?
Thank you, Lawrence. As mentioned earlier, in this first quarter, we see that there are some positive signs in the office market. Rents and occupancy rate starts to stabilize. However, if we look at the amount of new supplies coming in, it's still too early to say that it's going to be a positive year for office market. I think in the next 6 to 12 months, both rent and occupancy rate will continue to stabilize or decrease slightly until those empty available spaces are taken up.
Thank you very much, Dalich. I will actually add on something to that. That talking with our office leasing team, we get the impression, we feel that certain landlords have perceived the changes or the challenges over the past 2 years to be directly correlated with the pandemic and not necessarily directly linked to the oversupply issues that we are witnessing unfolding in the market. Of course, COVID has impacted the sector, but it's really important to emphasize the fact that we've witnessed quite a significant jump from 2019 in terms of supply. Last year, we saw around 200,000 square meters of net leasable area come online. This year, we're expecting to see 100,000 square meters of net leasable come online. So it's important when landlords are building their forecasts and they're thinking about where the market's going is not to over-focus on COVID-19. Anecdotally speaking, we suspect landlords at the upper end of the market may perceive this sort of COVID factor, and maybe they're starting to adjust or in terms of, or due to confidence, basically. They're thinking the market's recovering, people are coming back, but we suspect things will lag for a little bit. So maybe for the next 12 months, landlords will either stabilize and maybe even raise their rent. but the challenge will be how to respond to that oversupply challenge. And that's really where we see things going over the next 12 months. Great. So in terms of the next question, I think I'll fire one over at Kessa. So where do you see, when do you see the condominium market recovering? Thank you.
Thank you, Lawrence. This is a very hard question, honestly. It's predicting the future is always the hardest thing, a hardest part of my job. Anyway, condominium markets, as most of us and our audience here may have known, quite heavily depends on the international buyers more than local buyers, although we start to see that portion of local buyers now starting to increase. I would say that the recovery of condominium market with pretty much depends on the external factor, one of which very important factor is the recovery of China and Southeast Asia economic recovery, which is who are our key target market for most of the condominium projects. Recovery could look differently for different segments of condominium market. For example, affordable and mid-range might see more absorption coming from the local demand as now prices come down, and that could happen in probably between 12 months down the line. However, for high end, we're probably still expecting to see international investor to be the dominance of the demand market, and that could mean differently depending on what or the situation of the economic recovery in the region. Thank you.
Great. Thank you very much, Kessa. Really good insights, and I think you're on the money there in terms of the market can recover quickly. It all just fundamentally depends on what's going on externally, as it's traditionally been such an externally driven segment. We have a potential follow-up question. I'm just trying to find it from Irving Chan. What are the factors driving down high-end condo quoting prices despite the lack of supply? Thank you very much.
Thank you, Lawrence. Thank you, Irving, for the question. And I would like to continue from the previous response. I would agree that high-end condominium supply is relatively low if you compare to mid-range, especially. But again, the driving force of the demand in high-end are probably very different from what we saw in mid-range and affordable. I think again, international buyer, especially Chinese, Taiwanese or Singaporean buyers are the main driver of this segment. Again, as we discussed in the overview section, China economy themselves is still figuring out the way to go out, and the COVID situation in China is not particularly as stabilized as the rest of Southeast Asia. So I think this is also the reason why we see that the pricing continue to contract in the high and upper end of the market. Thank you. If you have anything to add, please feel free, Lawrence and Village.
Thanks, Kessa. I think an interesting question that we can look at is also what motivated new developers to jump into landed property. Did you see this trend in others like office and retail? I will make an initial point and then I'll pass it over to Kessa and Dalich. But I think fundamentally what we're witnessing here is developers following where demand lies within the Cambodian context. There's a significant, or there has traditionally been a significant amount of demand in terms of landed property, and what we're trying to stress and what we're trying to emphasize to our clients is follow where demand lies. So if you do have an office development, if you do have a retail development, As we have mentioned, there are certain strains that we're observing in the market. Certain landlords have the capacity, whether it's financial or in terms of their network, or even through working with groups like CBRE to attain the right tenants and bring them in. But having said that, not all landlords have that sort of reach. So in that case, what we're recommending is exploring what other alternative uses you may be able to find within your project. So that's exploring where, again, where demand lies. So it could be in alternatives like healthcare, it could be logistics, it could be data centers. All of these areas may be quite applicable and usable in these spaces. Jumping back to the landed property, again, this is just driven by where domestic demand lies for the most part. On top of that, it's an unusual segment because once you start a landed property project, you can stop and start depending on sales progress. And that gives you some sort of healthy ability to sort of control your costs. Whereas another segment, maybe like an office or a retail project, that only starts earning revenue when the door is open, when it's finally operating. Or maybe something like a condo, it has to reach the top. It has to be topped off. It has to be fitted out before things can be finalized. And that's probably where some of that differentiation comes from. Do any of the ladies have anything to add there?
Yeah, I think Lawrence made a perfect point on both developing based on where demand lies and the flexibility that we see for developer in the landed property market in terms of cash flow. Just small additions is I think a reason that a lot of new developer decided to pick landed property as the first point of development is probably how the nature of the sector is not as complicated to begin with. For example, office retail could be very specialized sector. You need a lot of experience, you need a lot of support from specialists to be able to develop and get it up and running. Whereas landed property market is probably what most local developers are more familiar with in the residential aspect. So as risk mitigation aspects or to cut down on risk, particularly, I think developers starting from what they're familiar with is quite a reasonable approach. Thank you.
Great, thank you very much for that additional insight. I think another interesting question is, are both office and retail markets getting back as they were pre-pandemic? And again, this is not necessarily the most straightforward question, but I will pose it to Kessa or Delic, depending on who wants to jump on that question.
Yeah, thank you. A short answer would be in terms of the number of people going to the malls, number of people coming back to offices, it's back to pre-COVID level. However, more significantly is the rent and occupancy rate. It is not there yet, and it's going to take a while. Like we've been saying, there have been a period of lag for the both of those levels to go back to pre-COVID level. Do you have anything to add, Kessa?
No, not particularly. I totally agree with Daluch's comments.
Thank you very much then, ladies. I think one important point to make is something I alluded to before, is pre-pandemic is 2019, and that was the hottest time that the market has witnessed. For instance, in the office segment, average occupancy was around 90%. And that metric is a really good indicator to see what pre-pandemic and the current state of the market is. So as mentioned, pre-pandemic centrally owned office was around 90% occupancy. As of today, it's around 66% occupancy for centrally owned offices. And that is, once again, it's not necessarily directly correlated with COVID-19. It's a reflection of this significant supply that we've seen increase in the market. And things will take time to absorb. In 2019, we observed an absorption rate of around 38,000 square meters per year. Through the pandemic, things have slowed, and as stock has risen, we are witnessing rental rates decrease, and landlords becoming much more competitive, especially when you're looking at things in terms of asking prices versus what actually transacts. So on that basis, we're seeing more value and more opportunities for occupiers. So this is translating into larger deals taking place. So pre-pandemic, the average size of take-up for a single office deal was around 150 square meters. And now we're seeing around 250 square meters, give or take. So on this basis, you can see that people are already taking up a significant chunk more than what they were pre-pandemic. So this may translate to more space being taken up as tenants are taking up more space, as there's more value available. So the key question is, how quickly can this absorb? How quickly can this change? And that really depends on how much supply is entering the market and how much space is being taken up. Just to summarize. Great. We will move on to a few more questions now. So in terms of this question, I think is perfect for Kessa. What kind of promotional marketing strategy do you think is applicable to the condominium? And I will add in the landed property market in Phnom Penh. Thank you very much.
Thank you, Lawrence. I was looking at the same question earlier. Marketing strategy in the condominium market has get really creative in the past year. We saw a lot of action going to market, either in terms of promotion of prices according to the payment term that the buyers are willing to offer, as well as the repositioning or changing the conditions of the unit handover to make the cost lower. For example, we've seen in some projects, the developer are offering a limited discount for a certain units, a certain number of units coming as a bare shell, which means no fitting out, no basic furnishing, no even tile floor in some cases, to keep the unit price really affordable. Also, in some aspect, we may have seen a mid-range unit price has now come down to an affordable range of price. I think this kind of promotion is quite attractive for some of the local buyer who don't mind the fitting out work, going out and having their own contractor coming in later when the building finished. GRR, guaranteed rental return, is also what we still see practicing in the market, although the success rate or attractiveness of this are probably not as much as previously seen in the market. Reasons are quite similar to who are the buyers in the current market. As you can see, a lot of local buyers are taking up the new absorption rate, whereas international markets may be more interested in the GRR offering. On the other hand, in landed property market, promotional activity could look really different. As in landed property, you will see, of course, a price discount coming with payment terms that buyers are selecting. Probably financing options is still remaining, although it's been around for a long time, but it's still quite successful. A lot of buyers still looking for supports and financing. So a lot of developers are now offering financing by themselves or working with commercial bank to offer a better financing option for the buyers. Offering of household appliance and say electronics and furniture are still quite attractive for many buyers. But as I would say, in landed property, the key aspects, key attracting aspect is still price and payment term. Thank you. Welcome to add if you have anything else to add, Aloj.
Thank you very much for that insight. Just a quick follow-up question on the landed property market. In what locations are we seeing the most activity in that segment?
The reason, the answer could be quite obvious. For landed property, we see growth in particularly outer districts of Phnom Penh, for example, I think Dong Cao and Po San Jay, where plenty of land is still available at an affordable price, still persisting to be perceived as the attractive destination for developers, especially new developer who are looking to, cut down some risk on the land price aspects. Some of the eastern districts such as Choi Chong Ba and a little bit to the north like Prek Phno is also rising in terms of attractiveness among developers for the same reason in terms of pricing, and as well as the improvement in infrastructure, which is now made those areas more accessible. I think this is the key attractive point.
Great, thank you very much. Again, while we're on this theme of residential, we've got a great question from Joseph. Have we witnessed any landed or condo developers default over the pandemic period, meaning due to cash flow or COVID? Are we seeing any abandoned projects or new developments? If either of you want to jump in, that would be great, and then I can follow up on that.
I can start, will be a short one. Yes, we have seen actually several cases of developer default, but compared to the whole market is still relatively low. Like I said again, because of the flexible format, the horizontal development format of landed property allow most developer to have some flexibility of starting and stopping the construction, and the financing from commercial bank does help to some aspects, to some extent. Thank you.
On top of that, also the nature of the sales of those landed property, it's pre-sale, so the construction hasn't started yet, and they're starting collecting some installment. So just to repeat on what Mong-san said, it definitely exists, but just a small number of those projects, and most of them are smaller ones, or by new developers, if those cases happen.
Great, thank you very much, Dulwich and Kessa, for those answers. Now for the challenging question from Adam. Which sector of the market is CBRE most excited about in the next 12 to 24 months? I'll kick off with that one, and then I'll let Dulwich and Kessa add in. As I alluded to earlier on, the key is really sort of trying to understand where demand lies. And trying to find something that sort of does not necessarily correlate with what is maybe easy to enter. So exploring maybe more sophisticated, more complex businesses in the alternatives, as it were. So as I mentioned, healthcare, education, logistics, cold chain, data centers, these are all probably going to be quite interesting. We're seeing resilience in the conventional real estate sectors for specific projects. So if a project's well located, if it's found some sort of niche, then it will do well. So we've been heavily involved with the launch of SCG Design Village, for instance, and that recently opened with a 98% occupancy rate, which I hope is public knowledge. But what I'm trying to get there is that it found a niche, it found something different, and as such, it's performed extremely well. And that's really what we're trying to emphasize to our clients at the moment is find the niche, find the path that is sort of less trodden, and that's probably where you're going to find success. I will hand that over to the ladies as well.
I don't know what to say because Lawrence covered all the important aspects. Just to add on, I would totally agree on looking at the niche market and staying away from the competition, especially in the traditional market. I think even from our polls, a lot of our audience agree that oversupply is quite a big risk for the real estate market in 2022 and perhaps continue to be in 2023 as well. Although we slow down in launches in some of the sectors, we probably expect the situation to be better and more active in the coming years, for example, 3 to 5 years further down the road. But for the current situation, diversifying away from these traditional market is probably a wise option. Lawrence picked up particularly on the niche market. Probably once other aspect is industrial, logistic, and manufacturing, which is also quite an important sectors. We have seen that the government has invested a lot of money into infrastructure development for the same reason is to improve as well as actively participating in trade deals, regional trade deals. This is a clear intentions that we can see trying to push further in terms of the manufacturing and logistic aspects in our country. So I think this could be a real potential, although we may not have enough time to discuss this aspect in detail. Thank you.
I couldn't agree more, and I think that's really on the money. As I said, as I used this phrase earlier, I think looking into these alternatives, looking in terms of industrial is definitely an exciting space, and it's definitely something that we're hoping to see develop, and we are slowly seeing develop. As mentioned, we're seeing this sort of Aeon launch at the beginning of this year with their logistics hub in Sihanoukville. We're also seeing this emergence taking place, the first real automotive industry taking off with regard to these assembly plants. So it's an exciting time for industrial. Moving on to another question, I think this could be aimed at Dulwich, is what key trends do you see developing in the retail sector in 2022?
Yeah, thank you, Lawrence. So key trends in the retail sector we expect to see this year are that there are more new brands, smaller brands, most of them, entering the community malls, new community malls. The reason being is as there are more supplies, developers have to find a way to fill in those available spaces, and they either bring in their own brand or some brands who are previously occupying standalone spaces are now moving into some of those community malls. So that is a trend we're seeing. Also some international brands ranging from entertainment centers to fashion brands entering the bigger malls as well. So those are quite exciting. So it's a newer mix of in terms of tenant mix to bringing something different, something more exciting into the malls.
I couldn't agree more, and that's probably one of the most exciting developments in the retail space currently. As this space comes online, it's more and more sophisticated, it's more and more attractive. There seems to be quite a strong Thai influence in Cambodia's retail market. So developers are going over there and they're exploring these concepts, or they're hiring Thai architects, and they're delivering really quite sophisticated products. And as we're seeing stock continue to enter the market, things are going to get more and more competitive, and that competition is going to directly deliver benefits to end consumers. So we're not only seeing landlords having to seek better and better tenants, we're also seeing them explore different concepts. So as Dulwich alluded to, we're seeing these quite sophisticated retail platforms that are developing, where we're seeing like virtual reality, augmented reality, technology experiences that just wouldn't necessarily even exist in other markets. So it's a really great time to be in Cambodia's retail space. I have a slightly controversial question coming up now, which is not necessarily going to be easy for us to answer, but which sectors are of most concern to you and why? I will start off with that because it's not necessarily the easiest question to jump into, but we've mentioned this shifting dynamic in the market, especially in the commercial space, where we're seeing quite a large increase in supply, or quite a significant increase in supply. And that's probably one area of great concern, without a doubt. As we see things getting more and more competitive, it's inevitable that we will see occupancy rates decrease. It's inevitable that we'll see rental rates decrease as landlords have to become more and more competitive. It's important to say that certain projects will be somewhat immune from these changes or these pressures, depending on location, depending on construction quality, depending on management quality. Management is really fundamental from the asset management side. That is, if landlords are not responsive to the needs of their tenants and these shifts going on in the market, they will lose out if we're being frank. So that's definitely somewhere of concern. But as I said, if landlords are savvy, if landlords are responsive, then they can really win in these challenging times. Please, if anyone else would like to add anything, go ahead.
Thank you, Lawrence. Obviously, couldn't agree more on this aspect. I think the current market situation, we are facing over a supply issue in almost across the whole board, ranging from commercial to residential sectors. Having said that, landed property is still moving ahead with new launches and absorption. Doesn't mean it comes without risk. But I feel that the risk lies in between the competition and price of some projects. But the points that could make developers stand out from the competition and mitigate those risks is offering values. We cannot stress enough on offering values because buyers now have a lot of choices. Also, tenants who are entering commercial space, they're looking for what developer can offer as opposed to other project or other option that they have on hand. So location is a core factor, cannot be denied. And then the value or the offering, for example, the quality of the construction, the amenity and facility that offering coming with the product is also very important. I think one aspect of the market that we didn't discuss in this presentation is hospitality, which is facing a very challenging time right now. Although I think things are turning around for hospitality right now as all the travel requirements across Southeast Asia are now starting to ease out, and although Chinese tourists, who is quite a dominance of Cambodian tourism market, still probably haven't returned up until maybe at least mid of this year. But I think things are turning around for the hospitality market as well.
Just want to add on that. We've all know, we've all been saying this for the past few quarters about the amount of supply of commercial sector, amount of supply in condominium market. But I think this is one of the very first time that we mentioned landed property. I just want to stress on what Wong just said. With the amount of new launches coming in, it rings a bell that as an investor, we also need to start being selective and being careful with what projects to invest in. I understand that a lot of locals are investing in landed property mainly for for price appreciation purposes, for rental income purposes. For those reasons, because those properties are landed and attached to the land, prices have been going up more than other sectors. However, it's very important to select good projects with good accessibility, good locations with existing supporting amenities in order to support the price appreciation that they expect.
Great. Well, I think on that note, it's probably time to wrap up our session. Thank you very much, Kessa and Delich, for your input today. And thank you very much to all of our audience for their brilliant questions. It's wonderful to have you all here, so we really appreciate it, and we look forward to working with you. Please feel free to contact any of us listed here today. We'll do our best to answer any further questions you might have and support you. I would also like to thank the RNC team for putting so much hard work into getting this deck together. Trust me, it's not easy. So it takes a lot of time to collect the data, to filter the data from all of our other departments, whether it's the residential team, whether it's the office team, whether it's the retail team, who I should also be thanking right now. So great, and thank you to CBRE, and thank you to everyone for participating today. So have a great Khmer New Year, which is taking place next week, and we look forward to seeing you in the new year. So thank you very much.